we're not really forecasting the surreal anymore. We're living it. And I think investors should be paying attention to history and math and facts rather than emotions or quick pundit tweets. But I was thinking the other day, and when I was in Cape Town, we were talking about gold and the COMEX and all these things. But I was thinking of this 18th century naturalist, a guy named Baron Cuvier, who no one would know, but he was a botanist, a naturalist. He said, I could look at a tree and I could look at a leaf, and if I studied the arteries in one leaf, I could tell the health or sickness of that tree just with a leaf. And I thought, he says that the rot is hidden in the leaf, so to speak. And in a lot of ways, to me right now, when I look at the markets, geopolitics, the economy, the rot is hidden in this complex thing called the COMEX. I don't want to get too wonky and get too into that. For some people, it's very familiar territory. For others, it's not. I mean, the COMEX is not a gold reserve. It's a credit platform, basically. And without getting into all the details of the COMEX, 400 metric tons of gold came in from England into the U.S. since Trump was elected in November and today. And that's fascinating in and of itself, and the reasons why. What's really important to understand is about 9 billion stood for delivery to go out of the COMEX. That was during the COVID crisis. 9 billion worth of gold going out of the COMEX, which is not meant to be a revolving door. The gold is supposed to stay in there, churn and roll over, and frankly, price fix gold. But what we saw in just the last week was 21 billion of gold going out of the COMEX. And again, without getting into all of the wonkiness of it, that's a massive indicator. That's a rotten leaf of a bigger tree symptom to me, this COMEX, because by the way, that's 4x the pace of what it was 2024. So why is all this gold leaving this credit platform? Because it's not really meant for delivery. And I think that's a question that people need to look at without having to understand COMEX, which is almost as intentionally complex as the derivative markets. It's supposed to be off your radar, beside your radar for average investors. But when you're seeing 21 billion worth of gold going outside the warehouses in New York and the COMEX and going back to the zip codes of the counterparties, that's saying out loud, no one's talking about in the mainstream media, is that the world doesn't trust the U.S. dollar, the U.S. Treasury. It wants gold as a strategic reserve asset more than anything else right now. It's kind of like an army preparing for battle, now wants more ammunition on its side of the river. And what is to come is there is a clear move away from U.S. hegemony in the U.S. dollar, not a replacement of it, but a repricing of it. And there's a clear understanding that this risk-free return or return-free risk of the U.S. Treasury is not nearly as important as physical gold, that analog old pet rock that people have poo-pooed for years. It's not a gold bug case. It's an actual piece of history happening right now in live time. So you can't underestimate what's happening in the COMEX. It's simply just more trusted as a strategic reserve asset than the once sacred cow of the U.S. Treasury. And again, that's confirmed not just by the fact that the BIS made gold a strategic, a tier one asset in 2023, or that the BRICS are stacking it, or that central banks have tripled their purchasing of physical gold since we weaponized the dollar in 2022. These are not gold bug cases. This is history in motion right now. And I think it's really important for people to understand that the world now trusts physical gold more than paper money in general, and the U.S. dollar and U.S. Treasury in particular. I think that's a really important thing that's happening right now. It's a major theme. Debt destroys. And as David Hume said in 1750s, and debt destroys bonds, it destroys stocks, it destroys currencies, it destroys economies. And again, the world is not ending, it's changing. The US is 26% of global GDP. China, another big competitor, is about 17% of that. So it's not like China's replacing the dollar or China's replacing the US, but it's changing. And the fact that, 45 countries are transacting trades outside the US dollar, that 30 countries are repatriating their gold inside their zip codes, that the BIS has made gold the only other tier one asset, that 20% of oil trade is going outside the US dollar. In terms of the other major themes that I think investors, obviously of all stripes, need to be aware of is what's happening in the markets too. It's not just another gold bug apology about the risks in the markets. This is something Jeremy Grantham at GMO is saying, Druckenmuller, Paul Tudor Jones, even Gundlach in the bond market, that these markets are grossly overvalued by every metric. I mean, the S&P, the Dow, the NASDAQ are trading primarily on momentum more than value. The Mag 7 is all about sustaining net income margins, which I don't think are sustainable, and we're just waiting for that to turn. Keep in mind, the S&P is trading at 7.5 times the global equity market. So the U.S. market is a massive bubble. And you can talk about the Buffett indicator, which is at all-time highs. That's a simple, stupid indicator. The fact that Buffett himself has over $330 billion in cash right now in his fund, and there's a reason. It's massively overvalued. And then, of course, there's always these key ideas that I keep in mind, like the madness of crowds by McKay. We're seeing the madness of crowds in speculation, whether it's Bitcoin or NVIDIA, etc. We have to always keep in mind Benjamin Graham looking for value. And I think most importantly and most overlooked when it comes to the markets is Bob Farrell, who's been ignored. The most ignored force in the markets is mean reversion. and markets could mean revert from these highs if we're talking a minimum of 50% retracement. Timing that is a different question, but it's open and obvious that there's massive market risk. And I think that just can't be ignored. Again, I've always said since over a year ago that the economy in the US, which is kind of the main kind of bellwether, is it already in recession. And you can look at the boring things like the Psalms rule or the conference board leading indicators or the yield curve moves. Those are pretty obvious. But I mean, the middle class is in recession. That's clear and convincing to me based on 13-year peaks in small business bankruptcies and credit card delinquencies at all-time highs since the great financial crisis, car repossessions. Again, Ed Dowd, this kind of BlackRock alumni, kind of a self-healing BlackRock alumni, he said the middle class is absolutely the working poor right now. And unless you're an immigrant or illegal getting sponsored, or you're at the real far end of the poor spectrum where you're getting support from the government, or you're at the ultra high net worth where pain is pain but you can survive, the real recession's already here. I mean, mortgage applications are down 63%. That's a clear bellwether to me. And finally, what I think investors really need to be aware of, geopolitics. I mean, where to even begin? I mean, you've got Jeffrey Sachs coming to the European Parliament explaining to them U.S. foreign policy in a very blunt way, educating them on following their own leaders, not themselves. You've got 1 million dead in the Ukraine, at least. This is not a war that's going to be won or could be won by the Ukraine. And again, we've got massive problems with immigration swings in Europe and the U.S. We've got proxy wars and a major pendulum swing politically from the left to the right now in the U.S. and now even more so in Europe with recent elections. So between markets, the economy, geopolitics, and what really is happening in the COMEX, this really is a surreal time. History is actually happening as we speak. It's not even something we're forecasting. And the ramifications of this in all of those sectors, whether it's the markets, the economy, your portfolio, and certainly your gold holdings, are to me almost too obvious right now. And that has me very concerned. It's a realistic proposition. It's ultimately, in my opinion, very impotent. It's kind of a guppy solution to a whale of a problem. And if we were to take that $42.22 certificate and market to market based on current gold pricing, you're looking at, assuming again that we have over 8,000 tons of gold in our banks and in Fort Knox, et cetera, you're looking at approximately 800 billion. And if we want to be generous, let's say $1 trillion, that we could revalue, the Fed plug that in the treasury, and then we'd have $1 trillion extra money in liquidity. Basically, it's kind of QE with gold, and that's great. Let's say it's $1 trillion, but really, what's 800 billion? It's a guppy again against a whale. It's 1 year's military budget. It's 2 quarters of unlimited QE, which we've seen in the past. In other words, $1 trillion is a lot of money, but given the massive scale of debt in the U.S., whether it's public debt or whether it's combined corporate household and corporate debt, that $1 trillion is a dopamine rush, but it's hardly a cure. And what I was talking about in that article more particularly is something about Kissinger. Be careful what you ask for if you revalue gold. If the U.S. were to do that, market to market, other countries have. Kissinger saw this in the 70s. A lot of European countries, which at the time had more gold than the U.S., were thinking, look, we're in debt. We're staring down the barrel of a debt crisis. Why don't we revalue our gold? And why don't we get the U.S. to do that too? And Kissinger was very, very afraid of that. Because if you do that, then who has the most gold wins, and that, so to speak. It's a cliche. Like, it's not a gold bug conspiracy theory. All of us in the industry know that the World Gold Council's view of China's gold holdings or Russia's gold holdings, for example, are woefully inadequate. I think they're off by 10x when it comes to China. So, China is the biggest importer and producer of gold. Russia produces 2x the amount of gold the U.S. does. So if you actually were to revalue gold and other countries were to follow, we wouldn't be at the top of the World Gold Council's list as the most gold-rich country. And so there is that Kissinger fear. But as I said in the article, it won't stop us from doing it because we are desperate. The U.S., which is the home of the world reserve currency, and the 10-year U.S. Treasury, which is a sacred bond instrument, it's desperate now. When we're talking about these type of measures, whether it's a strategic Bitcoin reserve or whether it's revaluing gold, I mean, we only have bad options, really. And, one option is kind of to play the Yellen card, which I said in the article. We could issue more IOUs from the short end of the yield curve. Then we have to hope that there's somebody at our treasury auctions to buy them. But when you look at the fact that our interest expense on debt, our military costs, and our entitlement costs are over 140% of our tax receipts, even a Yellen playbook isn't really enough to solve a real debt crisis. We could create, again, a Bitcoin bubble like El Salvador did and hope for the best, pump up Bitcoin, take some of those winnings and use that to pay down some debt. To me, that's very desperate. Given the massive level of U.S. debt and massive importance of the U.S. as a global economic leader, I've always said, and I've said it for the last 10 years, I'll say it for the next, our only real option is to inflate or die. In other words, to inflate away our debt, debase our currency, monetize our bond market with mouse click money by adding zeros at the Eccles building. That's been the playbook. That sadly is real option going forward, and we're just waiting for a trigger event for that. Or we could have that in combination with some type of global reset that the IMF kind of telegraphed in 2020. Again, none of those things are easy, but if we did revalue gold, to your question, that would be certainly a major tailwind for the gold price. It would be very poor for the US dollar, but a weaker US dollar might be good to help the US reduce its debt to GDP. But ultimately, what I wanted to make very clear in that article is revaluing gold is hardly a cure-all. It's at best a sugar high. The real problems with our debt are so much bigger than that. Frankly, even if we did do that, again, be careful you ask for, because when we start showing our cards, other countries, in particular China, are going to have a little bit more gold than we think. And if we revalue gold and they do the same, they're going to cut down their debt at a much faster level than the US. And so if we take that route, it's going to be a domino effect. And I think that's what Kissinger was very afraid of in the 70s. We should be just as much, if not more, afraid of it in 2025. My guess is we don't have nearly as much gold as we think. But again, we're all speculating on that right now. I'm certainly confident to say that China has significantly more gold than the World Gold Council reports.